Hi, this is Pete Andresen with Andresen and Associates. This is February 11th, 2022, and I'm just posting this as an update because it's Asian New Year. So happy year of the water tiger. We're going to be sending Afghan notes to all of our clients. We're sending these because we usually try to send currency of what was important last year. And last year, the American flight from Afghanistan, withdrawal from Afghanistan, certainly was one of the big moments of history, recent history anyway. So recently, the stock market's been down a little bit, not much. The investors still believe that the Federal Reserve will save them. And as long as that keeps up, we're not really going to see big declines, in my opinion. So I've been reading. First of all, if you want to know crazy, nothing says crazy like the 16th century. So I've been stocking up on studying Sebastian I of Portugal. That's interesting because that was an era that defined the foundation of the United States. That's where the founding fathers got the idea that the idea of royalty was anathema. That's when they got into the idea of separating church and state. A lot of what is good in the United States came out of the failures in Europe in the 16th century. So check it out. The Tudors, for example. Also, I've been reading about the financial panic of 1893. And the reason I'm doing that is the panic of 1893 represented a time when the Federal Reserve did not intervene, and there was a genuine risk that the United States would not be able to pay its debts. That's recent, and yet the United States did just fine, didn't it? I guess you could say the process of the United States government intervening in our economy resembles one of those bumper car rides where you careen from one side of the road to the other, but essentially you do get down the road. The thing that's interesting is that a lot of the time the economy has bounced off one barrier or the other, and a lot of the time that's due to government intervention. So governments don't necessarily improve the situation, but they do smooth it. For example, I think during COVID, we would have had a depression, which is very dire sounding, but it would be actually moderating effectively now. It would be going away now. I think that, and the stock market would be more fairly priced, probably. I think that what government does is it changes the dysfunction of the economy, and it might interrupt the function of the economy. I'll get into that later in some of the graphs. But eventually, capitalism itself, which is millions and millions and millions of people making rational or somewhat rational decisions every day, is what directs successful economies. So let's get onto this thing here. Share screen. Okay, we're going to go to Asian New Year here. Okay, slideshow from the beginning. Okay. So this is the year of the water tiger. That's according to the astrology charts, which are used in the Asian lunar calendar. And the theme for this talk is that things are changing. And I've been meditating on that a lot, obviously, as you can tell. If you're not my client, then this is great information, but you're not my client. I'm not giving you investment advice. Nobody has a crystal ball. Financial markets can go down. They can go way, way down. And my opinions in no way guarantee investment success. And I want to make sure we all understand that perfection, so far as I know, is impossible. Investing is always like that bumper car going from one side of the barriers to the next. So what's normal? I recently had a client tell me, let's wait until it gets back to normal. Let's keep this in cash until it gets back to normal. The problem is that there never, ever, ever, ever is a normal. Recently, I was hiking out in the Los Padres National Forest, and I had a chance to take a look at some Native American grinding rock areas. These are bedrock mortars. They were used to grind acorns. The Salinan Indians, who occupied the place for thousands of years, in their own way displaced somebody who had been there before. We don't know if they simply changed culture. I don't know. I'm sure somebody does. Or they genuinely displaced another group of people. But one way or the other, they moved from grinding seeds to grinding acorns. And these rocks that you're looking at, these holes, are beautiful holes, which were used by Native Americans, mostly women, to grind acorns for hundreds and hundreds of years. And behind them in that dark dirt are seashells that they brought the shellfish in to eat for 10 miles and feast. It must have been a marvelous life for them. And they probably thought it would never change. And it changed radically with the coming of first European diseases and then Europeans themselves with the mission system. But people persevered. A lot of people died, but a lot of people persevered as well. The Salinans are still there, actually, in a lot of ways. In our own history, I recall the 1976 election of Jimmy Carter, who won the election, and the talk that we would have, a civil war that we would have. If you happen to be as old as I am, you can recall the idea that the United States is basically divided in two. You'd see that the Republicans swept California. Wow, that is ancient history, isn't it? Basically, think about what we have experienced since Jimmy Carter. Jimmy Carter, I would argue, was sort of a failed president. A lot of what he set out to do didn't happen. He meant well. We had the Iranian hostage crisis. We had the Soviet Union at its high. We had Japan buying Pebble Beach, which is right next to us. Essentially, it was the decline of America, and everything was done. We were stick a fork in it. The American goose is cooked. Think of all the chaos and all the strangeness and all the reasons to expect dire consequences going forward since the Jimmy Carter era. Normal? How about these interest rates? This is from Ben Carlson's A Wealth of Common Sense, but you can get it anywhere. It's a very common graph. This is the interest rate on the 10-year Treasury, which went up to about 18% right here around 1880. Thank you very much, 1980, driven up there by the Federal Reserve to stop inflation, which was right in here, which isn't on the graph. But inflation then was worse than inflation now. And of course, like now, we have people saying that, oh, inflation will be with us forever. But inflation's never with us forever. It changes because inflation produces recessions and gluts. So this is the interest rate. From about 1983, it has done nothing. Well, not nothing. It's gone up and down and up and down. But the general trend line has been to go down. From 1953 to 1980, it went up. So somebody could say it's going to go up forever. Its interest rate's going to go up forever. But no, that's not what happened. It topped out and began to go down. And the Federal Reserve began to intervene more in markets. Now, brings me to my point. Capitalism, like I'm talking about the 1893 panic here, but all panics since then involve courageous people succeeding anyway. People succeed despite social climate and despite government. Government of any kind does not create success. It might cultivate success. It might provide a good or a bad climate. We're going to get into it because I think communist China is creating a climate of business creation, which is antithetical, is that the word, to business creation. But if you look at this, if you invested in the Dodge and Cox value, the Dodge and Cox growth fund, but it's really a value fund, since 1976, since the election of Jimmy Carter, $10,000 has become $2,558,428. Wouldn't it be nice to have invested $10,000 in Dodge and Cox stock and have the courage to just keep it? We'll get into some reasons why most people didn't do that. First Eagle Global, which is international, $10,000 became $1,998,000. Now, there's a theme here. Long-term, courage, people succeeding despite the current news. Think about all the news that's happened since 1976. Now, another theme is that managed mutual funds like these can, some of them, do better than the stock market index. If you look, the stock market did 10,000 became 1,437,000, which is astonishing by itself. But actively managed funds can succeed anyway. They tend to lag during, actively managed mutual funds lag during big bull markets like the late 90s and the mid 80s and now, but they tend to catch up when a stock market correction occurs. Finally, I have clients tell me, I can't take that risk. Well, a 60-40 blend of bonds, 60% bonds, 40% stock, pretty doggone benign. From 1976 made $10,000 into $697,000. So you can be a complete coward like I am and still succeed magnificently. But you have to have courage. In the process of making those millions in Dodge and Cox Growth Fund, you had to experience this, and actually was worse because the charting software at Morningstar only charts months. It doesn't chart days, but it was worse than this. Dodge and Cox stock lost in this down market, 2007 to 2009, lost negative 56.8. Okay, so $10,000 becomes $4,314.23. And I, as an investment advisor, will come to you and say, as I did if you were my client, buy, let's buy. And you look at me and you say, oh my God, the world sucks. How can we buy now? First Eagle Global was down 27.81%. What does that show us? 10,000 became $7,000. That shows us that diversification really pays off, because if you look at it, First Eagle did just fine, Ducky, thank you very much, but it was diversified enough to not fully participate in those down markets. Now we're using First Eagle right now for that. We're using Centerstone for that. We're using a variety of different mutual funds, but that's the basic plan. The other thing that this doesn't show is that there's a lot of mutual funds that just blow up, and that's what we call weeding the garden. That's what your investment advisor can help you with. And that's getting into those mutual funds that can keep on trucking. We actually get out of Dodge and Cox balance when the stock, or Dodge and Cox stock fund, when things are really, really high, because we know they tend to crater. But we're sure going back in, aren't we? Vanguard Wellesley, look at that, 60-40 mix, down 16.65%. $10,000 became $8,334. So if you're scared, you can still make, you can diversify some of that away with asset allocation. Finally, the Vanguard Index Fund, that's the S&P 500, was down 50%. I mean, 50%, one out of every $2 that you had is gone. And this is when many people sell out, which is exactly the wrong thing to do. If you want those long-term gains, you've got to be buying, not selling. But it's absolutely horrifying in the short run. And that's where most clients can't do it, most investors. However, and this is where weeding the garden comes in, the story of the Nikkei 225 shows us what can happen, and it's something that is always on my mind. In 1989, basically, the real estate of Tokyo was greater in value in terms of money, was worth more than the real estate of California, Oregon, and Washington. There was a tremendous, tremendous bubble in Japan. Japan has a different attitude, which we've kind of adopted, and that is that they keep the zombie companies that should fail, that should go under, they keep them alive because they want employment. So they keep creating subsidies and all kinds of infrastructure jobs that keep the dead companies alive. So we call them zombie companies. Anyway, the Nikkei 225 hit its maximum in 1989, and it has never recovered. And we don't want to be there. We don't want to be in that. So when things get horrifically overvalued, it's okay to diversify out of that. Solutions to financial market volatility, because it's coming. It's already here. Like I said, normal, what normal? Anybody have a cell phone 50 years ago? I didn't. So here's a solution to financial markets volatility. Number one, we're going to stay diversified. Number two, long-term focused. If you're my 101-year-old mother is still actively involved in her mutual fund portfolio because she does not expect to live another 30 years, but she does expect to leave a legacy. So for those of us, I'm 67, with my son joining the business, which is a joyful moment for me, I am planning on working another 10 years at least. I'm savoring that opportunity. However, I'm probably not going to live another 40 years, as sad as it is, but I'm still a long-term investor. I gotta be. Valuation awareness. I mean, let's get aware of when things are truly, truly, truly overvalued. And they are right now truly, truly, truly overvalued. What does that mean? That means if government intervenes, we will kick this can down the road and become even more overvalued and start to flirt with a Japan-like environment in the real estate, bond, and stock markets. I think we're already doing that in the cryptos. However, there are many little sectors of the stock market that are not overvalued. So it's not like we have to run to the sidelines. Also, since it's never normal, we don't really know what's going to happen. If the Federal Reserve intervenes, this could go on for another 3 years, or it could end today. Reality-based thinking. There's a lot of annuity sales going on. There's a lot of gold sales. Gold has a place. Gold has a genuine place during times of crisis. But it isn't a panacea. Crypto is not a panacea. Nothing's a panacea. Nothing is a panacea. You have to stay diversified. You have to try very hard to find reality rather than myth. Real estate never goes down, right? The S&P 500 is the only game in town, really? Right now, 5 stocks are about 25% of the entire S&P 500 because it's a weighted index. So we got to stay reality-based. We have to discount the media. The media doesn't make money telling us reality. It's clickbait. It says something extreme, and we respond to that and watch more, and then they sell us. So whatever, they sell us whatever the advertising is directed at. So discount the media, turn off the TV. Discipline. You have to stay on that long-term plan. Patience. We had a wonderful Zoom call with Abhay Deshpande, the manager of the Centerstone funds, the other day. I'm hoping to get the video on that. But one of the things he said that's wisdom itself is that he finds undervalued investments now, right now, in this overvalued era. He still finds them because the average investor can't wait 4 years. And that's true. The average investor can't wait 4 years. And that's why the average investor doesn't make a lot of money. So patience. patience, discipline, and then goals. With my son joining the business, we're going to be focusing more on client goals. What do you want? Long-term goals. They'll help you stay the course when things get challenging. And finally, courage. COVID's been a courage, it's been a gut check, hasn't it? And some of us have been more courageous than others. Courageousness is something we can define differently, and that's okay. We're all trying really hard to make the best decisions possible, but courage will pay dividends. We're going to have courage in the coming decade. This is what Vanguard thinks is going to happen, and I have to agree. Although nobody can really predict the future, I have to agree it's going to be tough in the coming decade, because here we are overvalued. We're going to see at some point, the stock market will inevitably do what it needs to do, which is clean out all those zombie companies by having a downturn. That's actually healthy. It's like wolves cleaning the sick elk out of an elk herd. It's healthy, it's challenging, it's scary, it's necessary. And I'm hoping that the Federal Reserve will just let it happen and not intervene sooner rather than later, because later means we're at Japan style valuations and it's going to be really hard to come back from that. However, it's going to scare the stuffing out of most of us, and it's going to scare me. I mean, I'll stay disciplined, but it's going to be scary. Returns on the indexes, not the actively managed mutual funds, will be much less than they were in the last decade. The last decade's been absurd. But the big difference is going to be in the bond market, perhaps, because every time the interest rate is 10-year treasuries at 2, which is a new thing based on yesterday's inflation rate of 7.5%. Okay, when that interest rate rises up, it's going to hit our debt load, which is excessive, and come back down again because we'll be forced into a recession. I noticed that Abhay Deshpande's concern was not just inflation, he's also concerned about a recession that rising rates will cause, which keeps a cap on interest rates. So you're not going to see you're not going to, probably not, this never say never, you're probably not going to see an 8% yield in the coming decade in a 10-year treasury. If we did, it would be an extremely chaotic economy. It could happen. We have a war, we have a big war, World War III type of stuff. We would have higher yields because the Fed wouldn't be able to keep the lid on them. But ceteris paribus, that means that's Latin techno speak for let's assume everything stays the way it is. We're going to be bouncing off that upper debt limit, debt ceiling that we can't crack. So yields should stay down. The bond market should be kind of asleep. So what we're going to do is we're going to go into equities because we have to. With AT&T yielding 8%, we're going to have to, which I don't necessarily recommend. It depends on your risk tolerance. That's where we're going to get yield from. So the 60-40 is moving towards an 80-20 somewhere out there. We tend to think that the world will look like this forever, but it won't, will it? This is 120 years ago, say, maybe 140 years ago. All these happy, dressed up people think that it's going to be horse and carriages forever and the world will never change. 20 years later, World War I hits, kills like 1/3 of all the eligible men in France. So change happens. If you have courage, your family and you have a good chance to thrive. Okay, that's all I wanted to say this week. Once again, if you want to see crazy, study the 16th century, and you'll learn a lot about how the United States got founded. Blessings, happy Asian New Year, courage.